Welcome to The Explainer. Today, we're going to tackle one of the scariest parts of investing: what to do when the market starts to tank. We're going to break down the psychology behind the panic, look at some hard data from history, and give you a real practical playbook to help you navigate the chaos. All right, let's get right into it.
Okay, just picture it. You wake up, you grab your phone, you open up your investing app, and it's a sea of red. Everything is down. The news is going crazy about a market crash. What's that first, immediate, gut-wrenching feeling that hits you?
Yep, that feeling is pure panic. Your first instinct is probably to sell. Just get out, stop the bleeding, right? And look, that's a totally normal human reaction. But, and this is so important, acting on that impulse is the single biggest reason most new investors lose money. It's not about picking the wrong stocks, it's about panicking at exactly the wrong time.
So why does it feel so bad? Why does a market drop feel so personal and just plain scary? Well, it turns out there's some real science behind this, and it explains why our brains are basically hardwired to make the worst possible decision. It all comes down to a little thing called loss aversion. It's a cognitive bias, and what it means is that the pain you feel from losing money is psychologically about twice as strong as the pleasure you get from gaining the exact same amount. So when your portfolio drops, your brain doesn't just see numbers on a screen, it kicks into a full-on fight or flight response, like you're facing a real threat.
Let's put it this way. Gaining $500? Yeah, that feels good. But losing $500? Ouch. That feels way, way worse. It's not a balanced scale. And that psychological imbalance is exactly what pushes us to make rash decisions based on fear instead of logic.
So if our brains are wired to freak out, how do we fight back? Well, the best weapon we have is data. Cold, hard facts. History actually gives us a powerful antidote to fear, so let's take a look.
All right, check this out. On average, the stock market has what's called a correction. That's a drop of 10% or more almost every single year. Let that sink in for a second. These drops aren't some rare crisis. They're a totally normal, expected part of the whole process.
Okay, what about something a little more serious? A 20% drop, what they call a bear market. That happens, on average, every 3 to 5 years. Again, this is not a once-in-a-lifetime disaster. It's just a regular part of the market cycle.
And what about the really big ones? A major crash of 30% or more? Well, that happens roughly once every decade. The point here is that these events are predictably unpredictable. They're not a sign that the system is broken, they are part of how the system works.
And now for the most important fact of all. After every single one of these storms, from the 2008 financial crisis to the insane COVID crash where the market dropped 34% in just 33 days, the market has always recovered. Always. And not only has it recovered, it has always gone on to reach brand new all-time highs. It just goes to show patience is pretty much the whole game. Okay, so we've got the psychology and we've got the history. Now, what do you actually do? Let's get super practical. Here is a 5-step playbook you can use to stay resilient and navigate the next downturn like a pro.
This playbook is all about shifting from being a reactive investor led by fear to a proactive one led by a plan. First, stop checking your portfolio every day. Seriously, all you're doing is feeding that loss aversion beast. Second, remember your why. If you're saving for retirement in 20 or 30 years, who cares what the market does this week? Keep your eyes on the prize. Third, and this is a huge mental shift, you have to see volatility as the price of admission. The market doesn't hand out returns for free. These drops are the fee. Fourth, have an emergency fund. This is non-negotiable. With 3 to 6 months of cash saved up, you'll never be forced to sell at the bottom just to pay your bills. And number 5, the expert move. Reframe these dips as opportunities. You're not looking at a loss, you're looking at a sale. It's a chance to buy great companies for cheaper.
I want to double down in that third rule for a second. Think of market drops like turbulence on an airplane. Is it uncomfortable? Yes. Does anyone like it? No. But it doesn't mean the plane is crashing. It's just a bumpy part of the journey you have to go through to get to your destination.
And that fifth rule? Well, that's basically how Warren Buffett made his entire fortune. This quote says it all. He said, "Be fearful when others are greedy and greedy when others are fearful." The biggest fortunes are made by staying rational and calm when everyone else is running for the exits.
All right, so we know what to do, but it's just as important to know what not to do. So let's quickly cover the 3 most common traps that absolutely destroy wealth during a downturn.
First up, panic selling. This is the cardinal sin. It takes a temporary on-paper loss and makes it a permanent real-world loss. Second, trying to time the market. Selling at the very top and buying at the very bottom. Nobody can do it consistently. And get this, data shows that if you miss just the 10 best days in the market over 20 years, you can cut your total returns in half. And third, getting sucked in by the news headlines. Financial news is designed to get clicks and stir up drama, not to help you with your long-term plan. Just tune out the noise.
So the next time you see all that red in your portfolio and you feel that panic start to bubble up, I want you to just stop, take a breath, and ask yourself this one simple but really powerful question. Is this decision I'm about to make based on fear, or is it based on the facts and my long-term plan?
Because here's the bottom line. Your success in investing isn't going to be because you're the smartest person in the room or because you got lucky. It's going to come down to discipline. The people who build real, lasting wealth are the ones who can stay calm and stick to their plan when everyone else is, well, losing their minds.